Imagine having your portfolio generating a passive income stream that can cover your living expenses indefinitely. No more punching the clock to earn a paycheck or worrying about your portfolio's fluctuating value. While dividends can be really attractive, they come with pros and cons which we will discuss later in the video. We will take a look at whether dividend investing is worth it and how much you realistically need to invest if you want to replace your income. First, let's discuss the fundamentals. When you buy a stock, you acquire a share of that company's profits. In some cases, these profits are distributed on a regular basis in the form of a dividend. They are fixed amounts paid out every quarter, and their yield is calculated based on the stock's current trading price. For example, if a stock pays $5 annually and trades at $100, the yield would be 5%. The return can fluctuate depending on the stock's trading price. Of course, not all companies pay dividends, as it's generally believed that companies only pay dividends when they can't achieve a better return by reinvesting their capital in their operations. Depending on the company, they typically range from 1 to 10% and can provide some of the easiest passive income you'll ever earn. From an investment standpoint, dividends offer predictable cash flow on a regular basis without requiring the sale of any shares. This leaves you with more money to invest in other opportunities. However, there are both pros and cons to consider when it comes to investing in dividend-paying stocks. Let's talk about the fun part of it. In the grand scheme of things, one of the positive aspects of dividends is that they are relatively insulated from market fluctuations, as we've seen in the past year. Market chaos may be present, but dividend payments are generally more predictable. For the most part, you'll receive the same payment regardless of whether the stock price is $20 or $40. This consistency is beneficial for those expecting a steady cash flow. Second, dividend payments are less volatile than stock prices. The Simply Safe Dividends blog reported that from 1900 to 2018, dividend payments remained fairly constant, with an average variance of plus or minus 10% during market downturns. In comparison, the S&P 500 has much more volatility. For someone expecting consistent cash flow, this stability is invaluable. Additionally, dividend-paying companies tend to be larger, more mature, and prioritize stability, which means you'll be holding on to companies that have been around for a long time. Third, during recessions, payments can sometimes increase. The same blog highlighted that dividends paid to investors increased in 3 past recessions, including a 46% jump following World War II. Although such an increase doesn't happen every time, the average dividend cut is just 0.5%, compared to the stock market's average decline of 32%. Fourth, dividend stocks have been shown to provide a comparable return to that of the overall market. Fidelity found that dividends accounted for 54% of market returns during times when inflation was above 5%, which means that even though they're not the stocks that go up the most during a bull market, they also don't decline the most during a crash. Lastly, depending on your tax bracket, dividends could be taxed at a much lower rate. If you receive what's called a qualified dividend, you'll have to pay no tax on that profit if you're single and making under $47,000 a year or less than $94,000 if you're married. Certain dividends will be taxed as a long-term capital gain even above that amount, which is significantly less than what you'd have to pay in ordinary income. While dividend investing has its merits, it's essential to be aware of the potential drawbacks that come with it. First, they are not guaranteed. Although companies typically aim to maintain or increase dividends, they may be reduced or cut during challenging times. This is particularly true during economic downturns when a company's profits may decline, prompting them to reduce or suspend payments. Second, dividend payments do not compensate for a declining company value. For example, a 5% yield may not offset a 30% decline in the stock price. This scenario is not uncommon and should be considered when evaluating the overall return on investment. Third, there can be tax disadvantages to dividend investing. Unlike capital gains, which are taxed only when you sell the stock, dividends are taxed as soon as they are received. Depending on your tax bracket, this can result in a 20% or more tax rate. Furthermore, dividends are taxed twice. First at the corporate level as profit and then when you receive them as an individual. Lastly, they may be irrelevant for some investors. Economists argue that if an investor needs the money, they can simply sell the stock, making dividend payments less valuable. In this case, a 2% yield could be considered equivalent to a 2% increase in the stock price, and the overall value of the investment remains the same. Despite these drawbacks, dividend investing can still be a powerful tool for those looking to replace their income. It's important to weigh the pros and cons and consider your specific financial goals and circumstances before deciding whether dividend investing is the right strategy for you. Now let's talk about how much you need to invest to live entirely off dividends. First, it all boils down to your personal expenses and lifestyle. The average retiree spends around $50,000 per year. Let's use that as a baseline. Second, when considering dividend investments, it's important to look beyond just the highest yield and focus on consistency. This is where the dividend aristocrats come into play, as they are considered the holy grail of passive income due to their consistent growth and resilience. This is a group of 65 S&P 500 companies with over 25 years of consecutive dividend increases. These companies have demonstrated growth and resilience, with only 2 years of negative growth in the last 20 years. Dividend aristocrats generally outperform the market during recessions, as they tend to decline less than other stocks. This is attributed to their focus on cash flow and their commitment to rewarding shareholders. The yields for these companies range from 0.3 to 5.3%, with most falling between 2 and 3%. To replace a $50,000 income with a 3% yield, you would need to invest approximately $1,670,000. This can be achieved by investing $5,000 a year over 40 years while reinvesting the dividends. If you're looking for a faster approach, consider alternative methods like covered call ETFs such as JEPI. It generates income through a combination of selling options and investing in U.S. large-cap stocks, offering a potential yield of 9.8%. However, this approach comes with limitations, as you'll see limited upside in the event of market growth and may still experience losses if the market declines. In this scenario, you could theoretically replace a $50,000 per year income with an investment of $500,000, which is much more achievable for the average American. Overall, it's worth considering that investing solely in a covered call ETF may not be the best long-term strategy, as their primary focus is generating income quickly. This approach could lead to significant underperformance compared to the overall market and potentially result in the loss of some of your initial capital. A more diversified approach is likely to be a smarter choice, even if it may require a higher initial investment. Remember that to live entirely off dividends, you must first determine their desired annual income from dividend payments. It is important to note that this is a general approach and individual results may vary. Factors such as the specific investments chosen, their yield, and the market's overall performance can all impact the total investment needed. While living entirely off dividends is possible, carefully considering the specific investments, desired income, and potential risks involved in this approach is essential. If you found this video helpful, make sure to like and subscribe for more content on personal finance and investing.